We're gonna have a lot of fun today. We're gonna get
There's so much to talk
We're gonna get super political, okay?
Oh yeah. Yeah. You're talking to the right person.
Where did you watch the election?
So I was at a watch party up in Mount Kisco, and it was good.
Okay.
Yeah.
Mount Kisco's far.
It's a little far.
Where are you?
Even from Greenwich?
Are you in Connecticut? Yeah.
In Connecticut, Stamford and Greenwich. And, that was an interesting night. My husband was up until 3 a.m. He said he hadn't done it since college.
Can I ask you, was the person hosting the watch party hardcore to one side or the other?
Yes,
obviously. But I'm going to just leave it there.
All right. Well, I'll tell you a story. I once went to a watch party at somebody's house, like a very fancy townhouse on Fifth Avenue.
Nice.
And like super all in for Hillary. Not her personally, but like an anything but Trump host.
Mm-hmm.
And so the party, let's say 70 to 80% reflected that. And this is like drop dead gorgeous home.
Yeah.
And it's catered. It's like there's giant TVs on multiple floors. And like there's like a vibe. And the vibe is we're gonna do this, we got this. And then like Florida comes out. And then Ohio comes out.
The mood changed.
Oh my God.
I'm sure.
I have never experienced maybe I have experienced this at like a sporting event where like the home team drops down 20 points or 30 points. And it's like, so it was like that, but worse. So I didn't say goodbye.
And it was supposed to be a festive atmosphere.
I Irish exited that place.
So bummed.
Yeah, I just disappeared.
Wow. I think that's the way to go.
Yeah, I don't think anybody wants to do a big, goodbye after something like that. Anyway.
This is true.
So my point is, the more political you are, the less you should want to host a watch party.
It's like being a football fan, right?
Yeah.
It's like hosting the Super Bowl when your team's in it.
When I think about football, I think about nachos and beer and Sunday afternoons, like very positive. But when it's a real fan and they're not playing well, it's not that fun.
Mm-mm.
You're not sitting down on the couch relaxing.
Yeah, but then you have to keep a smile on your face because you have guests.
This is true.
You have to keep the enthusiam up, even though you want everyone to just please get
leave.
out.
And get the catering bill back.
Would you please leave?
Exactly.
All right. Well, I had a watch party at the New York Stock Exchange this week.
Ooh, that's fun. No, you did the broadcast, right?
Yeah, I was with all the celebs.
Excellent.
There was some big names in this joint.
I love it. How did it go?
I thought it went great. It was the first time we ever covered the election from the exchange.
Okay.
So
it's like my favorite venue for it.
So here's what's interesting. It was a watch party on the 6th floor in the boardroom, like the chairman's room,
really
which
pretty.
is sick.
Yeah, it's totally sick.
But then we're down on the floor doing the show, but then there's these huge breaks in between because they don't want the markets people on the desk the whole time.
Okay.
So like we're at a little side desk, just like the market nerds. The real people covering it is like Carl Quintanilla, and he's at the main desk. So we do like, so we get on at like 7:40, and they're like, okay, your next hit is 8:50.
Oh, wow.
So it's like, we'll go up
to Harry's.
No, we go upstairs to the party.
Yeah.
The problem is I don't go to parties and drink club soda. I think you know this about me.
It's a late night.
Right. So that's one of the issues, and we stay there till midnight. So
was it till midnight? You were broadcasting until midnight. Oh, I didn't know that.
I got there at 6 p.m. I was there till midnight. So by the last hit, maybe I shouldn't have done the hit.
Yeah, fair enough. Now I'm going to go back to the tape. I want to see that actually.
But I'm a true professional.
Yes, I'm sure.
Tom Lee, we got the call down once. They're like, all right, guys, the next hit is 9:10. It's 8:50. Please report back to the desk. So we're all seated at the desk. Tom Lee comes with like a plate of food.
Oh, Tom is very relaxed about it.
He's like a focaccia. Scott's like, maybe we could put the plate off the desk.
Amazing. I love Tom.
It's very relaxed.
He is the absolute best, honestly.
He is. He really is.
So, Katie, yesterday we were talking about what moves in the market, any market yesterday, seemed like the most overdone. Or maybe the ones most likely to reverse. You know what? I was thinking about it after the fact. Maybe Tesla. Like, does Tesla really need to be up 20% in 2 days or whatever it is?
But it followed through today.
It did.
Yeah, and it actually looks like a real breakout. right?
You would assume.
Well, in terms of the resistance that it cleared.
It's right at previous highs. Like
yeah,
it's right there.
Yeah, right up against 300. Well, I think the dollar is looking a little bit crazy. And to see any currency make such a massive move in one day. So I'm more leaning towards the dollar and yields as being overdone. That might
said rates.
that might be a little out of consensus. Listen, there's definitely some equities that went a little bit too crazy, I think. And whenever you see all these gaps up, you get worried that the gaps will be immediately filled. So we're not taking that action and looking at it as a breakout. It's hardly bearish, right? But we're a little bit wary of its sustainability.
So there's like a timing thing. Like let's say you're like, all right, it's a red wave. They have all three houses.
A beautiful wave.
Effectively, this beautiful wave enables the Trump policy team to put through almost anything they want to do. The thing with the dollar is that that's a tariff trade. Mm-hmm. And they don't even need Congress for that. That's an executive order. He can do tariff stuff in January.
Yeah, and it could happen faster, you're saying. So
right. This other stuff where it's like, deregulation. Well, when does that show up in JP Morgan's earnings?
I know. And
2 years?
Yeah, the move in the financials was
wild.
Really anticipatory for something that could take a year plus, right?
The market doesn't wait.
This is true.
I think they think, right. I think they think 2025 is an M&A/IPO/ buyback and dividend bonanza.
I think it's coming.
And it could be.
Yeah.
I'm less constructive, but obviously it comes from a different place, right? And by that, I don't mean I'm bearish, but I do think that we're going to get into a range, at least for the first part of 2025.
I would hope for that.
Like a digestion phase is the way to put it.
I think bulls would want to see that. You don't want to see things go vertical. Like that's not healthy.
And we've just struggled to find like the entry, right? And I do think we're going to see an entry. I do think it'll come lower, and we just want to have more indicators on our side.
But by year end?
Probably not right by. I would
bet.
say we might see a correction start to unfold between now and year end, but I don't think it'll culminate necessarily before year end. That'd be really pretty dramatic.
Don't you, or do you think it's more likely that people are going to chase? Like if we don't, the longer we don't get the entry, the pullback, the people they're going to have to. They're underinvested. They got to chase.
They're already chasing, aren't they?
True.
You also don't. You also don't have under. So if it's President Kamala, then the conversation is, well, we better take these capital gains taxes this year, because if they enact something in 25 and it's retroactive to January.
Okay.
So I don't think anyone thought that she was going to have a blue wave and be in a position to enact anything anyway.
Right.
But I'm just saying, like, that counter narrative is not even a conversation now.
So people are trying to anticipate what is not going to happen now.
What's not going to happen.
Right? So, you have to look outside of the U.S. right now. European benchmarks, Japan, China aside, I do think that the global equity markets are telling us a little bit of a different story, maybe a more realistic one than the U.S. is right now. And it's not to say Europe leads U.S., but there's like a distribution phase there that's been resolved to the downside pretty much already. And Japan looks toppy is probably the best way to simplify it. So we feel that it'd be really surprising to see that completely shrugged off by the S&P 500. But honestly, if the Russell 2000 does confirm this breakout, you're going to hear me say confirmation a lot, because it's really important in our work. We want to always make sure any breakouts are like hold through another week. So for the Russell, it needs to hold above, I think it was about 2360.
Can't be a pop. It can't
just be up there for like a few days.
I'm going to interrupt you. We forgot to start the show.
Oh, let's do that.
We're gonna put these on our head. Michael, got yours on? Okay. All right, John's going to do the clicks.
Coming in with the 3 clacks.
All right. We almost forgot to start the show.
That's okay.
Hey guys, today's show is brought to you by Van Eck. There's a huge wave of demand currently and on the horizon from hyperscalers for data center power. Where are they going to get it? Possibly nuclear.
All right. So the thing about nuclear energy is that it's both clean and incredibly efficient. It's got one of the lowest emission profiles among energy sources. It can produce power 24/7, unlike renewable sources that produce electricity intermittently.
Did you know that there's an ETF that can capitalize on the demand for nuclear-produced electricity?
I actually did, and the ticker NLR was launched over 15 years ago and has been offering the most comprehensive exposure through various cycles in the nuclear space. To learn more, visit vaneck.com/NLR.
That's vaneck.com/NLR. Get nuclear today. Let's go, ladies and gentlemen. Welcome back to the world's finest investing podcast. My name is Downtown Josh Brown. With me, as always, my co-host, Michael Batnick. Michael, say hello to the folks.
Hello, hello.
You guys, John is here. Nicole, Duncan, Rob, the whole gang, Daniel. My friend, welcome to the audience. All right. Hey, guys, I got to tell you, when we bring back a returning champion, we put a lot of thought into how the first show went, and we really only bring back our very favorite people.
And also for the election, we had to have Katie.
Of
course.
Very political, very partisan. Katie is one of our favorite people. Katie's first episode on the show did unbelievably well. We heard from not only people that focus on technical analysis, but people that focus on fundamentals, people that focus on asset allocation. Katie's a star.
Biggest crowd ever.
Thank you. Wow.
You had a tremendous response.
I'm honored to be back.
So for those who don't know, Katie is the founder and managing partner of Fairlead Strategies, an independent research firm and advisory focused on technical analysis. Prior to joining Fairlead Strategies, Katie spent more than 20 years on Wall Street providing technical research and advice to institutional investors. In 2022, she launched her first ETF, the Fairlead Tactical Sector ETF, aka TACK, T-A-C-K, and that's been a big hit.
It has, yeah.
It's unbelievable. I mean, I knew it would work, but
it's not an easy business, by the way, the ETF business. So
I know.
I'm really proud of it.
Yeah.
I could have told you that, but
you should have warned me.
No, but it's a thing now. People reference TACK all the time. So
it's good to hear that. I mean, active products to me have a real place in the market, and it's sort of early adoption, but I think it's coming.
Active is the hottest category of all ETFs. It's not the biggest. It's the hottest over the last year. It's now it's not a fad. People are permanently utilizing different active ETFs.
But they realize they can achieve the returns and sort of the risk profile that they could maybe only before through a private fund with higher fees, right? So they're accessing good managers at a lower fee base with this nice like tax wrapper around it. So I understand why it's going that way. Transparency, completely.
Right. People know exactly what the manager is doing, and they can look anytime they want and say, what happened today in the portfolio?
You know, one of the challenges is that advisors don't seem to know where to put active products, right, in their overall portfolio. So that's what's the learning curve for, I think, everyone. I feel like it doesn't necessarily fit into a sleeve by the traditional means of the sleeves. Oh, is this large cap value? Is this, hedged equity? So that's going to be the learning curve. But I think if you think more of the outcome or the desired goal of these active products, that's going to help people understand where they fit.
Advisors like to be able to categorize things because when the advisor is talking to a client, it's their job to bring order to what would normally be chaos and say, all right, here's your portfolio. These are your core. These are like your satellite or core and explore. And I think it's easier to sell something to an advisor as a satellite than it is to sell as a core, because core is a race to the bottom on fees. Core is like Vanguard versus iShares.
But also when we're reporting like performance and you're showing a pie chart, like where does this thing, what slice is this?
Yeah, where does it fit?
What does
the
it
satellite,
accomplish?
though, to me, is like a catch-all in a way, right? So I'm hoping to see that morph into something a little bit more crafted to the investable implications of these strategies. And it'll take time to get there. Our product happens to be a very good core product, right? So that's another challenge for us, is that it doesn't really qualify necessarily as a satellite unless you're saying, okay, well, technical analysis, that makes it a satellite.
What about active sleeve? Like, shouldn't that be?
Could be.
Excuse me, alpha sleeve.
Alpha.
The client doesn't care if something's active. the client cares, is this going to do better than something else I could buy instead?
Yeah, and does it serve a purpose, right? Is
And
it
does it do
limiting drawdowns?
Does it do something unique?
Right.
Okay. All right. Well, listen, you have your lane now, and no, seriously. So, are we allowed to ask you what the AUM is? Are you allowed to say?
Oh yeah, it's all public. So it's about 220 million. Thank you to Trump.
Well done. Yeah.
So, Josh, before we get to the doc, I just want to, Callie shared this with us. So as we speak, Jerome Powell is giving his Fed press conference. They cut 25 basis points, as was widely expected.
Oh, I forgot. Was that going on this week?
I know.
So, all right, listen to this.
Just another market moving event.
Hi, Victoria with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go? Jerome says, no. Can you follow up on, do you think that legally you're not required to leave? And he just said no. So then somebody asked a follow-up. Do you believe the president has the power to fire or demote you? And has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Wow.
And he said, not permitted under the law. She said, not what? And he replied again, not permitted under the law.
Well done.
Jerome.
Stay off Twitter, Jerome.
Jerome.
I'm going to tell you right now, whatever laws you think are in place, LOL, pretty much if he wants to get rid of somebody, he can. He might have to use Twitter to get them to quit, but I wouldn't worry about Trump being able to do what he wants at this point. You might love that. That might be music to your ears. You might hate that. I don't know who, I can't speak to like every single person in every audience everywhere. I can only say
all at once.
This is what you should expect for the next 4 years. I'm telling you, it's a robber baron era coming. And again, you might make a lot of money in the next 4 years, so don't get mad. But we are now in an era where some very clever people have the attention of the commander-in-chief, and all of them want the same thing, which is their stock prices to go up. So,
yeah.
Speaking of that, Katie, going into yesterday, it had been the best return for the S&P 500 in an election year since, I don't know, what are we looking at, 1936, literally?
Yeah.
So given that backdrop, were you surprised with the violent pop?
We were anticipating a rally, but yeah, maybe the violence of it we were surprised by. The difference is that most of these elections, we've come into it after a pretty significant corrective phase.
Volatility into the election.
Yeah,
we didn't have that.
And it made sense because there's uncertainty. And I mean, if this one wasn't uncertainty or, rife with that, I don't know what was. So we came into it with almost like we had no sample size to reference over history for the current setup. Now that we have, usually when you get the gaps up after these prolonged up moves, that is more exhaustive in nature than otherwise. So again, we're sort of a doubter of the strength of this rally. And yet we don't want to fight the tape.
But the breadth doesn't change your mind at all because it was pretty substantially good.
Yeah, so good. But if you look at the breadth data, like the cumulative advanced decline line, it had lost some momentum ahead of this event, right? And so had the broader market. So even the major indices had seen a loss of intermediate term momentum that was somewhat meaningful. Weekly stochastics rolling over, weekly MACDs starting to get pinched, 20-day moving averages roll over. And those are usually indications that we're into some consolidation phase, right? So I don't want to give too much credit to, a 2-day move and sort of, I guess, it doesn't negate what we've already seen from these indicators, including in market breadth.
John, can we put this chart up, S&P 500 year-to-date returns in election years? I understand what you were saying, that the rally was sort of like narrowing going into the election, but it was one of the calmest 30-day periods going into an election ever, maybe because everybody that wanted protection already bought it. Like everyone was girding for a worst-case scenario with recounts and ballot boxes and all that.
Yeah.
But just on the overall year, like to Michael's point, it's back to 36. From my perspective, understanding what I understand about human nature and the agency problem and Wall Street and people's careers being on the line.
It's on.
I just can't picture anybody leaving the party, especially if they're trailing, which of course 50-something% of active managers are.
Yeah, and I don't think anybody should leave, right? But
no, of course. I understand what you're saying.
They might want to wait to add exposure or get partially hedged. While the U.S. was very calm and obviously had great returns, we didn't see that overseas. So developed global markets were not enjoying the same follow through. So I think that lack of global breadth is something that nobody's really talking about. Kind of, it nags at me a little bit. The participation on Wednesday was really very broad, as you mentioned. We saw, I think, 420 stocks reach new 52-week highs on the NYSE.
Yeah.
We haven't seen that since, I think, 21. And that's
that didn't end well.
No, it did not. It wasn't right at a peak, actually, the measure at this level. But it did give you a sense that things might be getting overdone. So we always look at those market internal measures, sentiment, breadth, leadership, all of that from a contrarian lens.
Okay.
And so in mid-October, reasonably so, sentiment got overly bullish by historical measures, right? Fear and greed index got very, very bullish. So 75% is that extreme where you do tend to see markets start to sort of lose their stronghold.
Is it important to you at all that financials were the best performers? Is there any signal there in your work? Or is that just something that's coincident with the moment and not necessarily predictive of anything?
It was a really explosive move.
Yeah.
And I think we need to evaluate it more on a case-by-case basis. Look at the individual stocks that have run up. I looked at JP Morgan for one.
Wild.
Looks great. I can't argue against that chart. And certainly beneficial to the holders, right? So to me, they're all holds on that gap up. But we do have, and the Russell 2000 move, by the way, is really part and parcel with the financials move.
There's a lot of small cap banks that drag that thing up.
So the regional banks were up massively. And with these gaps up, we just be careful. We'd wait for that confirmation. So not to be overly sensible, but we want to wait until really kind of next Friday to make sure that the breakouts that have developed above resistance levels hold. And that's where we can add value just by, taking out some of the emotions of this week, of which they're running very, very high, right? And if we see them confirm, well, that's great because that suggests that it genuinely is broadening out in a way that we really haven't seen, at least from large to small and mid.
What's an ideal situation for next week then? Monday, Tuesday, profit taking, and then a resumption of strength into the end of the week?
I would say that, yes, in a way, like digestion would be great, as long as that digestion doesn't start to see the major indices and a lot of individual high-profile names come back into their gaps.
Yeah.
I don't want to see those gaps penetrated for the most part. And the lows from, yesterday, they're far enough away that I think we have some wiggle room.
So we could retest without breaking down into the gaps.
Mm-hmm.
Okay.
Yeah, just kind of a hanging around current levels would be healthy.
So yesterday was the largest positive day in the S&P 500 post-World War II on an election day. Was up 2.5%.
John, we have this from Bespoke.
And again, coming off the strongest year in election year heading into the day. It's just a wild.
What the hell happened in 1948? Anyone?
No idea.
Know?
No idea.
Who is Duncan? Who's the president? 48. Is that it's Truman?
Rob says Truman.
Truman was the president. Yep.
It's Truman, right? Okay.
Market did not like
so
that.
I guess the market was not a big fan of nuclear bombs going off, or all right. So all right, this is pretty notable though. No matter what, it's a historic day. The problem with yesterday, I don't know, it's a problem. The thing with yesterday is that in 4 years we're gonna have another election. We're gonna have all the content leading up to the election. What do stocks normally do? Blah blah blah. This is gonna drag everything higher.
That's right, the averages.
And you're going to hear everyone say, make sure you're in for the election. Like,
you make a good point because it's the same thing with any seasonal phenomenon, right?
Yeah.
We have front running of these seasonal factors, right? So what somebody said, well, Q4 is always strong. Okay, well, it's already been pretty strong.
And everyone knows it's going to be.
And then Santa Claus rally. Well, is it possible that we've already had the front running of that seasonal push higher? So
no, buy the rumor, buy the news.
I like it.
So I like to front run longer periods of time. I don't front run the Santa Claus rally. What I like to do is say 30-year periods are usually pretty bullish. So I'm going to get in today, and I'm just
Well, to take a long-term view, I actually agree with that. If you can put on blinders to a lot of the noise that happens over the short term, you're usually really well served by that. When we did a lot of back testing for our ETF, we tested different sort of signal frequency, dailies, weeklies, monthlies, et cetera. And we found that the longer term generally either built on returns, certainly improved on the strategy by not over trading and not getting you out of a market when it was just correcting, right? Corrections are healthy. They are worth living through, maybe hedging partially through them. And the market's usually in a bull market, right? So we want to make sure that we're there for those environments. And you can't do that if you're trading around all the time.
Well, the problem is when you're in a correction, you don't always think it's a correction. You think it's the start of something worse.
Well, that's why you have to use technical analysis, right? And do it systematically.
We agree with you on that.
Yeah, the emotions get taken out of it. I think about the COVID corrective low. Now we can say that, right? It didn't feel like it was a correction at the time.
But it looked like we're about to get cut in half.
Yeah, it really felt pretty awful to me too. But if you use the indicators, they wouldn't have gotten you sort of fully risk off, at least in our work. And they would get you to a full equity exposure way before I think you'd be comfortable yourself, right?
They would buy you back in.
Buy you back in.
Well, that's the part.
That's the hardest part.
That's always the hardest part. Yeah.
So there was, as we mentioned, just an explosive move to the upside yesterday. Let's talk about small caps for a second, because this is the area of the market that's been the but. Right, like
the laggard. It's not confirming.
Yeah, it's like the mega caps are going up, but look at the Russell. Well, actually, did you know, John? This chart's a little bit further down. Raise your hand if you knew that over the last year, the Russell 2000 is outperforming the S&P 500. Now, that only just happened as of today.
12 on a 12-month basis.
Really?
How wild is that?
Yeah.
Wait, really?
Yes.
How?
Really? All right. So I put a new one in here, but as of today, it's. The Russell 2000 is outperforming
I see it too.
on a total return basis of the last year. Is that wild?
Nobody knows that.
That's
I would never have guessed that. I would have bet money against that.
Now you know. So anyway, Kevin Gordon tweeted yesterday, the percentage of Russell 2000 members trading above their 50-day moving average moved up by 17 percentage points. That's insane.
I mean,
it went
really
from like
insane.
50% up to 76 or whatever the numbers are. That is the strongest increase since July, when really this rally into small caps kicked off when we got that weaker CPI report.
Right. So is that a good thing? And if you look, it's probably not, unfortunately.
It looks like it oscillates and we're at the upper end.
Yeah, and we're at the upper end. We're nearing what ends up being a peak in absolute terms for the index.
It's a good thing if you were in it a month ago.
Already, yeah.
Not a good thing to buy into it necessarily right now.
We've had really good outperformance off of just the recent low, Russell versus S&P. And what I think a lot of people are hoping for is that this coming year is more about the small caps, right? Because then there's more opportunity and value. There's a lot of things that come with that I think the market would welcome, because it's not all that sort of leadership stronghold to the mega cap complex. And it makes it easier, I think, especially for financial advisors, to add value in a way that honestly they just can't when it's all the Mag 7 and all passive, right? So I think people are hoping for that environment. The catch is it's an environment that I think is more likely to occur in a range or sort of a down cycle where we have that small cap
that's
outperformance.
Interesting. Small cap outperformance, because that was a big phenomenon from 2000 to 2009. Was that small caps did better than the S&P.
Seems unfathomable today.
And it was range bound.
But I mean, in 2022, I'm looking at the ratio. It was pretty much equal, right? So is it good to see the ratio of the Russell to the S&P sort of stabilize? I don't know that it's good or bad in terms of the market implications, but maybe it gives us more choices, more to work with, right?
It's good for IPOs. If people feel like there's interest in market caps below $50 billion, they're more likely to bring deals to market.
Yeah.
And those deals are more likely to be supported by people that are willing to bet this thing is going to get into the Russell in a year if it maintains its $6 billion market cap. Like, there's no interest in that part of the market right now.
Good for Wall Street, certainly, too.
I think it's good for, I think it'd be good for Wall Street. Let's do this. Let's do this IWM chart with the gap.
So sentiment trader Jason Gepford tweeted that it was, this is yesterday, the fourth largest gap up in IWM history. But if you take out 2008, which was obviously not great, not bad in terms of returns on a go forward basis.
You could skip this 2008 was the TARP approval. Is that why you had that gap up? You could skip that. That's a once in a century.
Again, there's 4 events, so looking at forward, I guess you could pretty much you could toss this out the window. But it was notable just in the sense that the gap higher and in a bull market nonetheless. So I guess, Katie, to your point, like, is this the exhaustive gap that gets filled next week? That clearly that's not what we want to see. So when you're thinking about gaps, because I joke around that like all gaps get filled. That's my like unofficial thing. But there's a difference between gaps getting filled, 3 days later and gaps getting filled, a year later. So how do you think about like holding gaps?
So I think of them as a great way to manage risk and to identify whether it's a real breakout. So if it gets filled immediately, that usually is a bad thing. That's a bad thing, right? But I kind of agree. Yeah, you do often see them filled much later. This chart's interesting, but I have to say, look at the corrective phase right ahead of the last 4 instances.
Right. This usually happens in a bear market.
Yeah, much different environment.
So you think about gaps at an all-time high not for a stock, for an index. A gap at an all-time high has a different connotation than a gap after like a 12-month consolidation or okay.
So those we would call breakaway gaps typically.
So that sounds like it's a good thing.
A breakaway would be following a downdraft actually.
Oh.
So that's more of like a turnaround.
So what kind of gap is this? Baby gap?
It would be
What do we
this
call
would
it?
be exhaustive.
An
if
exhaustion
it
gap.
is filled, obviously that's when we know it's exhaustive. But it would be more likely exhaustive.
So when you say it's a good tool for risk management, so let's say you have a trade on, not you, your ETF, but like anybody. Let's say somebody has a trade on. They got this right. They bought small caps. They anticipated the catch-up trade, the Trump trade. It did work in 2017. I would point out. People love these little industrials and banks. Okay.
These little industrials.
They did. It was a hot thing for like 6 months. I was there. You were there. Let's say somebody got this right this time. What does the gap do in terms of giving them a risk management fulcrum? What do they do with that?
Yeah, well, first of all, it just makes it so it's math, right? It's all about price, and you don't have to have the emotions involved. So I'm looking at IWM right now on a daily chart. Yesterday's low
Michael's going to put this trade on as you're talking, by the way.
232 3/4, right? So
Okay.
that's our effective stop loss, right? We don't want to see that, but it has a limit. It's within like 5 days. And this is not that scientific. But
and you want to give that like a weekly, like a Friday look, you're saying. You don't want to react
Yeah, this
instantly.
would be more like, if within the next few days it dips into the gap, to me, that
over.
makes the whole thing so much lower probability that I want to be out.
But
right?
if it doesn't get in there within the next 5 days, then we've set a new floor for now.
Flip the book.
What it also does, it makes you take pause, right? It can be at times very frustrating because then you'll see maybe additional follow through. But this gap up also happened to be associated with a whole lot of DeMARK sell signals. You guys know the DeMARK indicators,
Yes.
right?
Remind us, what is that?
So
these are all the numbers?
Yeah, they're designed, the numbers, right?
count.
Floating above and
Paul Tudor Jones
below
was a big fan of this?
He is, and Steve Cohen. So,
And Kanye.
they're one of the best ways to identify trend exhaustion, in my opinion. So we can all look at a trend and identify it. Just use a moving average, a MACD. For us to understand when it might be nearing exhaustion, that's harder, right? So usually we'll have lagging indicators that will roll over, like those stochastics.
And it's already too late.
Yeah, it can be.
Yeah.
They're going to get you there closer than waiting for a breakdown at least.
So DeMARK is literally counting the days in a potential exhaustion period to note either the end of a selling trend or the end of a buying trend.
Right. So it comes on the downside
It
and
could be either
on
way.
the upside.
But when you see those numbers on the chart, that's not subjective, is it?
No,
Okay.
it's really model driven, completely mathematical. There's like some basis in my opinion, and Tom, this is not this. He owns this suite of indicators, but my sense is there's some Fibonacci sequence that's embedded in the indicators, and they're truly one of the most timely things that you use. But we can.
Some people use it better than others because there's an interpretive
I think that's where I was just going to go.
All right, please.
Yeah. Just cross-referencing, right? So if there is a breakout, then one of these so-called sell signals becomes lower conviction. So there's some people that might follow it more to a T than we do. So we're always cross-referencing with other indicators and support and resistance to put more odds in our favor. But with these breakouts associated with a lot of 13s, including, by the way, the S&P 500 cash today, we want to just doubly make sure that we see that confirmation.
So you have a chart, you have a bunch of charts for us. One of the ones that you brought is a fear and greed index with the 10-day moving average. Was this going into the election? Like, what are we looking at here? Because it looks like fear and greed was rolling over.
Yeah. So coming into the election, it was actually somewhat conducive to the bounce, right? Because I think it was around 43%. But notice that the sort of faded gray line did reach 75% very recently. That was that mid-October reading. And we like to isolate it with the 10-day just to kind of smooth it out. But you can see that the periods during which the sentiment metrics sort of rolled over, right, generally are not great periods for the equity market. You would see some consolidation that needed to get you back to a level where people could feel comfortable adding exposure. So we feel like sentiment is a risk right now.
So you ideally are looking for a moment at or below the green line for a lower risk entry.
Yeah.
But this is very short term.
This, I don't know about very short term.
Okay.
It would be more intermediate term. So for me, that's like, each quarter.
Okay.
Right. Sort of the swing.
Okay. So we were definitely more toward the greed portion and then rolling over.
Right there. And it's when you see that 10-day rollover that it tends to be like think of it as like an overbought downturn. And you don't need to see it go all the way to the oversold reading of 25% to get an entry. And by the way, that's when the market feels terrible generally, right? And
well, I was going to say, like, this year, it really never did, other than that one moment in August
low, yeah,
where I don't even know what was going on. I think like the non-farm payroll numbers started to accelerate negative, but it was really about storms.
Claims?
Yeah, but like Texas had a storm, and we just decided, now is the recession.
It was claims. It was
claims.
Yeah.
Okay. But all right, so that's really the only moment where you had a very obvious, sentiment just got way too negative short term.
Entry point off of sentiment. And I mean, look at each of those. I mean, there's what, I don't know, 6 over the last 3 or 4 years.
Were those all great buying? I mean, everything's been a great buying opportunity.
Pretty much. Yeah. So, and
look, March 23 is the mini banking crisis that almost happened. Like you could like shout them out.
Just the October low last year. What a beautiful entry that was. And sentiment helps us feel confident in adding exposure when it does feel that bad emotionally, right? So we don't feel like it's, you could describe it as neutral right now, but it certainly tells us that if you want to add exposure, probably better off waiting. Right?
Okay. I like that way of thinking about it. Yeah. If you're about to put money to work, and you are under some sort of a constraint about getting the timing right for a 90-day period, and a lot of asset managers are, like, is today the best day? Not definitely.
Probably not.
Yeah, I know. And I know that's hard because the market does have such momentum, right?
It doesn't wait for you to get in.
Let's do this cumulative NYSE advanced decline line.
So we got a sell signal? How dare you, Katie?
Yeah, I know. And what I like about this—
I admire your courage.
is that it tells us that breadth has been strong, right? Because I do feel like people are still kind of harping on 2023 when breadth was really lousy for the most part.
Let's do 30 seconds on MACD. So this is moving average convergence divergence. Is it indicator? But it's not predictive of anything. It's telling you what has just happened.
That's right.
Tell people why that matters to technicians.
Well, we want to eliminate noise. We want to identify prevailing trends, and we want to also understand if those trends have good momentum, right? And the MACD serves all three in a way. So it's a trend-following metric. It'll tell us, is it an uptrend or downtrend over various time frames?
And it looks, for the listener, it looks like a wave, and you'll frequently see it as the bottom pane of a chart of something, stocks.
And it has crossovers, 2 lines. One is a data line, one's a signal line there for crossovers. And the crossovers will give you so-called buy and sell signals. They'll give you an idea of whether it's a trend shift that's meaningful enough to act upon. You can evaluate it for divergences as well. And you can also see if momentum is growing or contracting. You might still have upside momentum, but it could be less so than it was a few weeks ago. And there's information in that.
You want to buy the upside cross of the signal versus the data.
Generally speaking. But, you always want to cross-reference that with everything else. So
it's not the only thing.
The MACD
It's
itself
one
probably would test all right, but certainly not perfect because it will at times eliminate too much noise. So we want to enhance it with things like the stochastic oscillator and the DeMARK indicators.
But what is this chart? So you have a chart here, cumulative New York Stock Exchange advanced decline, which I think everybody understands what that means. This is the number of stocks going up minus the number of stocks not going up, and cumulative meaning it's not just today,
every
it's
day,
building.
Yeah, it builds on itself.
Okay,
yeah.
so that, if I know nothing about markets at all, I look at the top pane of your chart, you're showing a 40-week moving average. That looks amazing to me. That's
it's
record.
A very good uptrend has been in place since.
So why do you show these two
October low.
things juxtaposed with each other?
It's to show that the uptrend has lost momentum, right? And it's not an outright, as much as it says MACD sell signal.
It's like a yellow
to
light.
denote the that's right. It's more like
I'm
keep
sorry,
an eye
this
on
is a
it,
MACD of the thing above it.
Yeah, that's right. Yeah.
Okay.
So it shows that the breadth has actually lost momentum, which is kind of interesting. And all that would tell me is to say, okay, if we do see breakdowns in absolute terms by whatever, we're going to be more likely to honor those breakdowns and react to them because breadth contraction can be pretty tough.
Well, we're getting a breadth thrust in, or a surge, I should say. I know a breadth thrust is an actual thing that's being measured.
A breadth surge. What's the difference between a breadth surge and a breadth thrust?
A breadth thrust is mathematical. Okay, like that's.
I have to be honest. Just the term thrust makes me very uncomfortable.
Well, I'm very comfortable. I am a thruster.
I know that you are.
All right, so breadth and Nasdaq surging. Chartkin made this chart that shows 14% of Nasdaq stocks are at a 52-week high, and historically, this has not been a top signal, like at all.
Yeah.
No.
So why is this? All right. So this is an interesting question. Do you think about Nasdaq stocks differently than the S&P 500?
Yeah, I would say collectively, yes.
Okay.
I give more weight to the S&P 500 just
It's
as a
more
broader,
stocks and it's
a broader sector representation. And so I think of the NASDAQ as being a little higher beta in general and also a little bit more mega cap heavy, right? So those things matter. We often, if we're recommending hedges, short-term hedges, we will use the inverse triple Qs or PSQ for that recommendation.
You'll get more
as
bang for your buck
to,
on
that's
the hedge
right.
that way. Okay.
So because oftentimes you do see the technology sector to which the NASDAQ is more heavily exposed underperformed on the downside, right? High beta. So we want to get that tech exposure when we're getting hedged.
So if you're putting on a hedge to the S&P 500, the right way to do that might be, but don't you also pay the price for that if the market continues higher, you're definitely paying a beta price because the Qs are probably going to outperform.
Of course. Yeah.
Okay.
Yeah, typically, I would say. But we have seen the Qs, and this is not a technology problem as much as it is a mega cap problem. When you have Apple and Microsoft, which are two massive heavyweights, as you know, having kind of lost their relative performance, that is impactful to the whole benchmark.
Let's do this secular and cyclical trends. What's this first chart? This is a monthly chart of the S&P 500 index.
A great chart. Yeah, so it shows a lot of the—
I'll be the judge of that. Tell us what's in it.
It shows the indicators that we use most, including the DeMARK indicators on there.
So there's your number. There's your DeMARK count.
So you see the secular bull trend. You see that the shaded area, that's our cloud model. And it shows that we are likely to get into range and then resume higher, right? So maybe a cyclical range, and then the secular bull can resume just visually. It's not really a gauge of support right now, too far away to matter. Hopefully it won't have to matter. We also had the stochastic oscillator that's in the middle window there, and the MACD indicator with the histogram in the lower window.
What is the stochastic pane telling us? Because you have as a note here, long-term overbought.
Yeah, so we have to clarify to folks that overbought is not necessarily bad, right? Overbought is actually a
mathematical term.
I have JC in the back of my head. How can too much demand for stocks be bad?
Yeah. So, and it's momentum, right? It shows momentum. What's bad is kind of what you saw with the sentiment metric where it rolled over from overbought. That's when it's bad. It's when you get the stochastics coming back below that overbought threshold, which happens to be 80% in our work. So we are overbought, and that has us, sort of on edge, but we don't have an overbought sell signal. So that's how we'd interpret that. The one thing that we've been using more and more this year, if you look at the MACD, the histogram in the bottom is another way to represent it. And it's basically the spread between those two lines. And you see how it kind of like it builds a mountain and then peaks and then
one peaks before the other.
Right.
What I say.
The histogram is showing sort of the convergence and divergence of the MACD. And what we found is there's real value in trying to identify that peak in the histogram because it will occur well before the MACD sell signal itself. And it'll give you, again,
It's
a sense of—
indicator for an indicator?
Yeah,
This is what Warren Buffett uses.
Yeah. I was going to say, you're playing it just like Berkshire.
It's
All
like
right.
two derivatives away from price, right? But that's about as far as I'll go.
All right, but anyway, the bad news is we've got a big fat number 13 up there. That looks ominous.
It does, doesn't it? And listen, they're not perfect, right? If you look over history, but it does, again, have you sort of bracing for something that could lose
13
momentum.
is the DeMARK count for this monthly candle.
That's right.
What is that? Why is it 13?
And it's a 13 on the daily as well. It's a 13 because of the qualifiers that Tom has sort of built into this one indicator that you see here. And the
I
qualifiers—
think it's pagan in nature.
I'll give you an example of one of the qualifiers. In order to go from, a 10 to an 11, the close has to be above the high from 2 bars ago.
Okay.
Don't quote me on that,
Yeah.
but
Okay.
it's something like that, right? So it's looking at how price is trading in the current price bar versus bars, 2-4 bars ago, and it's therein measuring
So it's like
price momentum.
It's like an extended. So it's so crazy is we were you're saying, not you. The formula is saying we were a 13 before this week. Like
So-
ending October as a 13?
The
What are we
13
now?
Well, the
50?
13 was actually there in October, but based on October's close, it disappeared, which is one of these very frustrating things for people like me. But now in November's bar is up there.
Oh,
We
okay.
do have—
so this is.
So it is not locked in. We'll only know that at the very end of the month. But it does give you just a visual sense that it's overdone. And by the way, we're not terribly far from that measured move objective, 61.18. It's a pretty widely known objective.
What does that take us to?
At
6,000? Just a little bit more?
6,100.
6,100. Yeah, 61.20.
So that would be a measured move in Fibonacci terms.
Which is, this isn't even really Fibonacci. It'd be like a 100% replication of the move that preceded the bear cycle.
I think even the most bullish of bulls would say, yeah, it would probably be healthy if we could just correct through time a little bit. Just digest, take a breath.
Just visually,
Yeah.
right? And let's hope it doesn't have to look as sort of pronounced as 2022 does when you take a step back.
So I want to be careful with correct. It needs to correct. I think most bulls would say they would prefer a consolidation, not a correction.
That's
correct?
a good
Because
nuance.
where does
yeah,
a correction? Where does a correction take us down? Where does that 10% move take us down to from today? Is that 5,200 ish?
Yeah, here's
That's
the
not
catch: is like
pleasant.
every consolidation or range, unfortunately, has to pretty much start with a correction, like a proper correction to establish the low point of that range.
Yeah.
So we do think that we'll get that correction. That is probably going to happen relatively soon, and that's why we're just saying hold off on new purchases, hedge some of the higher beta exposure that you have partially. We always say partially because we want to be there for the bull cycle. Our fund is 100% in equities right now, basically. So we're still exposed ourselves, but we do see, look at that MACD histogram. It kind of feels like it's peaked to me.
Okay, so that sounds completely reasonable.
Yeah.
And one of the beautiful things about using technicals is not that you'll always be right, but it's when you take action and do something, you can point to a reason why you did it. And also, if it was the wrong thing to do, whether you shouldn't have bought or you shouldn't have sold because the outcome went against you, the technicals will help you fix it.
Well,
That's
they won't let you be wrong for too long, is what I say.
That's actually the better way to phrase it.
Yeah, and JC and I were talking this morning about how.
Did you get a word in edgewise?
I did.
Okay.
He's very generous.
Okay.
But we're very much like philosophically on the same page typically, right? And when we think about technical analysis as a discipline, people are like, oh, it doesn't work in this environment, or it's not. We agreed that it's not technical analysis that ever fails anyone. All technical analysis is the identification of price trends, analysis of supply and demand. Where it falters would be in the eye of the beholder, right? So it would be me saying, you know what, I'm probably giving a little bit too much weight to these overbought, oversold metrics in an environment in which, I probably should have given more weight to momentum. So it's more in how you're weighting the various inputs that you get from the technicals that I think you can be on the wrong side of things. But the market won't let you stay that way for very long because you're just going to have to concede. And that might mean, for me, the MACD does something that just I give up type of thing.
I think with technicals now, there's more of an appreciation of how they can be used even by people that are not technical analysts to manage risk. I think where technical analysis as a discipline gets into trouble is when something happens and somebody pulls an indicator out of their ass that you've never heard them use before and say, yeah, look, this totally explains it. But that's any the fundamental people, same thing.
Systematic approach is really the right way to go with most disciplines. And
you shouldn't have a new indicator just because the one you normally use didn't spot something.
Confirmation bias.
They don't do that in fundamental analysis. There's no community adjusted EBITDA. Oh, wait.
Oh, yeah.
All right. So I know you're a fan of intermarket analysis as a technician and ratios and all that good stuff. So I want to show you what I think is one of the most bullish charts in the world, which is the equal weight consumer discretionary stock divided by the equal weight consumer staple stock. These are Invesco products.
Okay. That's good to know because I didn't realize it was equal weight.
Well, the reason why it's so important, as you know, is because
you were going to say it's all Tesla, it's all Amazon.
Yeah.
Well,
I was ready.
XLY is 40%, I think, Tesla and Amazon. So
it's a great index.
If you look, if you look at the equal weighted version of the discretionary divided by staples, it is ripping to new all-time highs.
It is, yeah. And listen, if that breakout's confirmed, then that'll be meaningful, right? So I'd make sure that
it's a risk. It's another risk on
it's
indicator.
Very much, it's like this week is the week that it lifted above that resistance. So I would just make sure that it holds up there, right? And that would be bullish in my opinion as well as just one sort of enhancement. And it would also, in a way,
put it this way, you wouldn't want to see the reverse. You wouldn't want to see a 1,500 point rally in the Dow, and this is the reverse.
Well, look what happened. So look at 2020, right? This ratio crashed during the bear market, ripped during the bull, crashed during 2022, and now we're on fire again.
Yeah, and it feels a little extended to me, admittedly.
It's going vertical. Yeah, me too.
Yeah, I thought a few weeks ago that it was rolling over.
Well, this will fix itself. It has to. It's a ratio chart. Like at a certain point, it
oscillates. Yeah.
And we also had to remember it's hard because we do a weekly report that focuses on sector relative performance, right? And we give overweight, equal weight, underweight recommendations with an intermediate term time horizon, which to me is very helpful.
What's intermediate term to you?
So if I had to say weeks to months would be sort of the general, if you could center it maybe around 3 months.
Okay.
And then for short term, it's days to weeks. Long term would be 6 months plus.
Okay.
Like that.
So what sectors look good based on the last thing you put out?
It's funny because it's in this weird transition period right now where we're actually equal weight most sectors in our recommendation because you've seen like a transference, right? So tech has kind of fallen out of favor. So that's equal weight. Energy is still underweight, but maybe that'll move to equal weight as it transitions potentially here with drill, baby drill. Banks, financials, if you look at the ratio, it's probably pending confirmation of a breakout this week. But my guess is that we won't get that confirmed breakout in the ratio. So we're equal weight financials as well. So equal weight a lot. But if you take a step back and look at the longer term view, we have an RRG, relative rotation graph. So
we've seen
really
those.
Cool.
Jeff at Renmac has one of those too.
Yeah. Julius de Kempenaar is the creator of these, and they're a way to look at relative performance normalized, and you get this cool data visualization tool.
It's like a wheel, and you have some sectors rising, like growing in relative strength, while others are falling. I don't know that it does anything for a 10-year investment, but if you're like, what's working now, that's a really great way to visualize it.
It's almost even better for that 10-year time frame, just to give you a general sense of what's unfolding. And if we look at a 6-month view of sectors within the S&P 500 versus the S&P, it favors utilities, REITs, and staples, which that gives me information, right? It kind of tells you it's rewarding what we saw in the way of a relief rally in relative terms for those sectors. It's saying that the momentum has shifted. And then conversely, tech and communication services look the worst. They look like they're the ones that are rotating out of favor.
Is that bullish or bearish to you?
That would be bearish, yeah.
Because they're so big. Those market caps are so big.
It's the market cap, but it's even more so than that. It would just be the defensive sector rotation that could imply. But it's not something that we're taking as like investable information. It just creates a backdrop. But the challenge that I was going to mention with the sector rotation and relative performance is that people don't realize that you really are talking relatives, right? We're not saying with an overweight recommendation necessarily to go buy that sector. So that's a challenge on our end in terms of making sure people know that they're not totally independent, right? But relative performance is, something that you want on your side, but it's not necessarily a buy or sell trigger.
You agree with Michael, though. This is a bullish chart. It might be extended, but it's like what you would want to see.
Yeah. Oh, yeah. Yeah. That's supported the uptrend for sure. It shows risk on versus risk off. The consumer staples stocks have gotten pretty interesting, I have to say. Well, as interesting as they can, I guess.
Look like shit in the rally, and like it should be obvious that it would. Pharmaceuticals.
Yeah, and right.
Trump hates these companies.
Kind of makes sense.
He doesn't like. I think
Lilly has a breakdown.
Yeah, it doesn't look good.
He's going to start yelling at them about drug prices for sure, and he wants to make deals with them all for the U.S. purchasing of drugs.
Biotechs look good, though.
And Bobby Kennedy is
better.
like, I think, anti-vax.
Yet,
he might be involved with the FDA. Those stocks look awful.
Yeah, they've been really beaten up.
Yeah.
In that, sometimes there's opportunity, but you don't want to be too early. We've been constructive on Boeing as a good example of a counter trend, sort of hopeful.
What are you fucking nuts?
Hopeful trade.
You don't, but you don't seem to be. That doesn't seem to be central to what you do, like falling knives.
No, it's really not. No, and listen, and Boeing, honestly, we only got there recently once it showed some stabilization and held trend line support, that type of thing.
But you're not looking for that.
No, we're trend followers. We much prefer to have most of our positions be in long-term uptrends. We're okay living through corrections, as you've heard. But
you were about to say something interesting about staples.
Oh, yeah, the staples. So the corrective phase that has sort of damaged their relative performance of late brought a bunch of these high-profile names into their 200-day moving averages, which are often kind of I want to say even self-fulfilling as support at times. So it was like General Mills, Coke, Kimberly-Clark,
really defensive.
PG, all of the really, very high profile but not very exciting consumer staple stocks had these pullbacks simultaneously. So it was very much a sector move, right? Not specific to any of those individual names. And I feel like that was at least a short-term entry for some of them.
But a good entry, right?
A good entry, yeah, and something
because they should find support there.
Well, these names have been in wild uptrends, and they're giving you an opportunity to get back in.
Yeah, some of them, and it feels also like if you are like me expecting consolidation, well, the consumer staples relative performance should be a little bit better, right? And so it feels a little safer to me. So not only do you have an oversold reading near their 200 days, you have the potential for staples to be better insulated if we do get into more prolonged consolidation.
Know what happened this afternoon as we're sitting here talking? The largest market cap company that's ever existed in the United States and ostensibly in any country, NVIDIA, hit an all-time high for any market cap of
150 yet?
Any U.S. stock ever. It's $3.63 trillion. No U.S. stock has ever been that large. NVIDIA is at 148. All-time high.
It's another
people ask you about people ask you about NVIDIA more than any other stock?
They do. Okay. Yeah, they do. I mean, I really...
How good are semis looking?
I have to say that's not the best chart that I've seen.
Exactly.
Yeah.
Interpretation.
So what do you tell people that ask you, because if the people are asking you about NVIDIA, they're either in real life, they might not use these words, they're either asking you for permission to buy it because they missed it, or they're asking for your like stamp of approval for them to keep holding it.
Well, right. So a lot of them already own it, and they're wondering if they need to manage risk somehow around their position.
The answer is yes.
Often,
you need to manage risk.
Yeah, I would think so. The big sell signal, the DeMARK indicators that you saw in the S&P is shared by NVIDIA on its monthly chart. So, and NVIDIA has been such a huge influence on market sentiment and really a driving force, as we all know. It's a general, big time. Yeah. And it's not to say that it's a bearish setup. It's not to say that everybody should sell NVIDIA.
All-time highs are not bearish. JC told me that.
No, this is true. But if for someone who feels like they missed it, just be patient.
Let me throw another chart in your face. All right. Does Micron look a little bit better?
It's more of a turnaround. So, you
want to wait for it to clear?
Well, yeah, there's
What
some
about that chart do you
there.
like? I don't understand.
Me?
Yeah.
If it gets past this, because I'm not a triple top guy, don't believe in them. If it gets past 113.50, it's gone.
Yeah, there's no triple top because it hadn't been trending higher. For me, with a lot of these, and in fact, it does have a DeMARK buy signle, by the way. That's active. Short term.
All right, so you and Tom DeMARK, what else you got?
2 weeks in duration, so you got to be there now. But for these, the semis in general, I'm not talking like ASML with its breakdown, but just kind of a generic semi actually has a pretty notable loss of momentum that's carried over to the monthly chart. So it's really not a great sector right now. What I think there's, and you guys might feel it too in your conversations and with your clients, is that there's just interest really, not even just the mega caps, but really very tech-centric interest.
But software not susceptible to tariffs in the way hardware is.
Yeah.
It's like seems to be, like I was looking at CrowdStrike and some of my software names. These things look like regional banks. Like
so it's a really mixed group. I just looked at them today for someone, and some of them look just like the S&P, right? And those to me are the ones that carry a little bit more risk. And then others, like look at a HubSpot or something. These names have just been on fire, and they're coming off of what were really long-term base breakouts. Even Zoom, as one that was beleaguered,
I bought and sold it. Damn it!
That's why it's working.
But remember, software is dead. Like Salesforce. And Salesforce did get murdered. But look at that chart of Salesforce. Came roaring all the way back.
It did. Yeah, it came right back.
Can we do this Microsoft? Impressive. Let's do this Microsoft stuff. Katie, you have a chart here. But what did you like? Can we do like a second on the Wall Street Journal quote?
Is this from me? I did put it this in here.
Is this from you? Who's this from?
Who did this?
The Wall Street Journal
the
quote.
AI
you know what? Guilty. I'm sorry.
It's
This wasn't me.
right?
This wasn't me. Okay.
Not me.
So I want to make sure we get to this.
All right. So listen to this from the Wall Street Journal. This is Nuck and Futz. The AI boom has transformed Microsoft's structure and its balance sheet. In the past 4 quarters, the company's CapEx were $64 billion, up from $36 billion in the period a year earlier. It's now spending in a quarter what 5 years ago it spent in a year. Microsoft is spending in a quarter what it spent in a year 5 years ago on capital expenditures, and ostensibly all going to
a lot of it going to NVIDIA, not all, but a lot. Yeah, it's GPUs.
It's wild.
And data and building construction for data centers.
And notably, the company recently disclosed that all its AI services combined are pulling in revenue at a rate of $10 billion annually. Does anybody want to bet that it's not going to be $20 billion in very short order?
I don't. Let's do the Microsoft chart. Buy, sell, or hold.
I mean, would you guys buy that?
No.
No,
not yet.
Me neither. Yeah.
No.
Brand new MACD sell signal on the monthly chart, right? So
and an overbought downturn now rolling over.
That's a great example of where it goes from overbought healthy to overbought problem.
Can the market survive this if this looks this way and then we get something similar with Apple? Like can the rally hold up?
It feels like it rests on the shoulders of NVIDIA in a way, right?
Is this a good chart?
Yeah.
I know it's rhetorical. The answer is this is a disgusting chart.
There's some support.
Okay, but this is, so I was about to ask, like when you're thinking about ratio charts, so
what is that?
This chart is Microsoft divided by XLK, and it looks like trash.
Yeah, it looks
so.
It's really underperformed.
When you're thinking about Microsoft relative to, I assume, are you relative to its sector or the market?
relative
looks
to the
different.
broader market.
Okay.
Yeah. But I mean, it's not a great ratio.
It's not great either way.
Yeah,
But hold on. The quote in that article ends with, the company recently disclosed that all its AI services combined are pulling in revenue at a rate of $10 billion annually. Maybe I'm an idiot. It doesn't sound like you can spend $64 billion a year in AI CapEx for $10 billion in annual revenue for a really long period of time. So either that CapEx number I don't want to say comes down,
It's not
but
coming down.
stops accelerating, which I think probably hurts NVIDIA, or it stays where it is and Microsoft starts to lose a lot of money.
Yeah.
But it feels like one of those two things has to break.
And and neither are good, right?
Neither are good for the market.
So yeah, I mean, I don't have a handle on the fundamentals, of course.
So you would not get long Microsoft here, technically.
So if your time horizon is like a week or two, sure, it's got a short-term oversold upturn within this context. So the time frame is really important. And in fact, as I look at the ratio, it does actually have a counter trend indication. Maybe it just means that the underperformance has gotten to the point where it's a little overdone.
But if we're zooming out, I mean, this is still very much in an uptrend. Like, let's be real.
It feels toppy though, doesn't it? I mean, to me, it's got what could be a classic Head and Shoulders top unfolding there. So I think it's somewhat risky from a long-term perspective. And certainly at a very minimum, there are much more compelling setups out there.
Well, if this thing breaks down to 360, I'm in.
Away from the charts for 1 second. I think next year, the conversation shifts from LLMs with the AI stocks to agents. And agents has the potential to become a really bullish investing theme. So something interesting happened this week. Google accidentally made its Jarvis AI product available in their own store, their own app store. And then they pulled it like a day later. A whole bunch of people downloaded it. They couldn't access it because it wasn't really ready. But it seems like this is going to happen before the end of this year. For those that don't know, Jarvis is an agent. So this is not asking an LLM to help you with your homework. Jarvis allegedly will have the ability to call a restaurant for you and get you a table. Jarvis can then change your reservation because you tell it to. Jarvis can put you on an airline, which to me sounds like the hardest problem on earth to solve given how many variables.
Yeah.
Like, I want to fly out an hour later. No, wait a minute. I want to be in first class. No, wait, how much is the price for this? But whatever. If that's where we're going next year, I feel like it's hard to not be in these AI stocks because Claude already exists. And what these agents are doing is taking screenshots of your computer while you work.
Scary.
So that they can then replicate the things that you already do.
Imagine if you could have it call your health insurance company and stay on hold for you and get it done. I mean, that would be a game changer.
Yeah, let me read this. Let me read this to you. This is potentially very creepy. It's called on-screen awareness. That's what the next generation of AI is going to be about. It's going to watch you in action and then mimic you when you ask it to do something.
What if you're incognito?
Dude, you have a lot to worry about. That's a separate conversation. All the news about Project Jarvis is giving us major deja vu because of how many times we've seen the capabilities being touted just by another company. So Anthropic has Claude, which Amazon is all in with Anthropic. It controls your computer for you. Already works. It'll be taught to use computers by taking screenshots, sending them back to the model to analyze what's happening on the screen. Apple Intelligence is going to do on-screen awareness, which seems like it's very invasive. Observe your activity, feed that into its system to intelligently carry out those tasks for you on another occasion. Microsoft has Copilot, famously, plus Recall, very nosy. It's all in your business.
I love it.
This is where things are going, and that makes it for me, somebody who really wants these tools. I don't want to give up on any of my NVIDIA stock. I don't want to, because I feel like this breathes new life into the story.
Yeah, can't you just buy PSQ, right, to manage through any risk that
I suppose
you're
I
carrying?
could. I suppose I could.
If you wanted to get hedged to some degree, it is hard to time the entries in a stock that has such good momentum. So I think the message is, maybe you hold your existing position, you hedge through top-down sort of avenues, and that's your risk management. I don't think you also have to, sort of incur taxable events if you're trading in and out of these core holdings.
Yeah.
So if it's a core holding, we usually say as long as that core holding has long-term upside momentum, stay with it. But then you can sort of hedge it.
Yeah, you don't want to churn yourself in a position that you view as like truly core to what you want your portfolio to be invested in. I agree with that. We can't let you get out of here without Bitcoin. This is exciting. This is like an exciting week, not just because of what the price did, but because the decriminalization of investing in this stuff is now coming. And I just can't. I said this over the summer. I said Trump's going to be the Bitcoin president. He's just going to fall in love with all the money that's come to him during the campaign. Now he has all these really smart friends, and they're going to stay very involved, it appears, with the administration. And a lot of the dominoes will now fall on the side of this becoming more mainstream, not less. Like, there's probably going to be change at the SEC. You also basically have the acquiescence of Larry Fink and even JP Morgan.
Acquiescence of Larry Fink.
Yeah. He's all in. But 3 years ago, he thought it was a scam. So we have to watch Bitcoin. Now, the added reason is that this might become a reserve asset for the government.
Mm-hmm.
Okay.
Yeah.
So now this is now something that every technician, every macro person, they have no choice. They can't dismiss Bitcoin any longer.
It's a great example of where you can't fight a trend indefinitely, right? So when you have a breakout, and this one is looking like it will confirm this week, you have to honor that breakout as acting as a positive catalyst as long as you don't have any big sell signals, and Bitcoin does not have any of those. So we do also get from Bitcoin sort of diversification in a portfolio. Our recommendation really historically has been that everybody should have a small position in Bitcoin, even just for the call option of it really working and really exploding. But now also from a technical perspective, with it having advanced from a downtrend channel that had been in place since March, that's a big deal, assuming we see it close.
Got a new high this week.
Look at this weekly chart. How that is so bullish.
You would buy
almost like
any stock
every day.
It's a cup and handle.
Cup and handle. Yeah.
You would buy any asset that has that setup.
Yeah.
I think
the cup and handles are pretty high probability. Even Microsoft, before it got into this corrective mode, had this beautiful cup and handle breakout and follow through on the back of that. So we like this breakout, assuming it's
John, can we put Katie's chart up? It's toward the end of okay. So, all right. This is Bitcoin weekly.
Mm-hmm.
You're looking at both a 10-week moving average and a 40-week moving average, and you have a cloud. And you're looking at that cloud area as if it falls, as long as it stays in there, it's still intact.
It shows a good band of support, essentially below current levels. It served as a staging ground for the most recent relief rally. Momentum has shifted.
Oh, sorry. But you're labeling this a pending breakout. Ain't nothing pending about it, girl. Like this.
See, this is where it frustrates folks, especially in a high beta asset class.
Say
like
why
this.
it's pending. Say why it's pending.
Because we haven't had the 2 weekly, and we have to say closes with quotes for Bitcoin. The 2 weekly finishes above our resistance
So could this
level.
confirm for you by next week?
It's Sunday. Yeah.
Sunday.
It's when it rolls to a new price bar on the weekly
The good news
chart.
is I could buy it Sunday when you text me and say
You'll see it
confirmed.
coming. You'll see it coming. And just make sure it's actually me.
So why are you saying measured move 80,600? What is the significance of that?
That's just based on the width of the pattern and where it's come from before. It's that same 100% extension. It's only any measured move is assuming the existing trend is resuming and in the similar slope and fashion.
So, but what does that mean to the person that goes long on the breakout? Like 80 is where they should think about taking profits?
It's more of like an objective. It would be a stopping point, a natural stopping point on the chart, but by no means should it be where they say, okay, I'm going to close my position there. It would be a natural place for consolidation typically.
Okay.
So even with that 6,100 level for the S&P, same type of idea there. That doesn't mean that's where it's all done, bull cycle's over necessarily. But it's an objective that if it's reached, it would be a natural place for it to pause.
My price target is derived a little bit less scientifically than yours. I'm going to say 110,000.
I've heard that before, yeah.
But the reason why is because once it goes to 100, that's when like the real desperation starts. Any asset management firm, any asset allocator that has no Bitcoin is going to want to fucking kill themselves. And that last burst at the end, and that could take place in one day, that's like $1 trillion coming in. as it breaks 100,000.
And we've gotten to the place where there is
It's like FOMO on steroids.
There are more ways to invest now, of course, in Bitcoin.
Oh, it's easy.
Now it's easy.
Yeah.
And I don't feel like it has the institutional adoption really yet. But
None.
just imagine if all of the pensions out there, or the state funds, what if they picked up just a little slice?
Central banks.
Yeah.
This is like actively being discussed at the U.S. Treasury. And if the U.S. Treasury decides this is a serious asset for American stability or whatever, you're going to have central banks in other countries say, well, I guess we have to do something. It doesn't have to be a lot because we're talking about trillions of dollars, that are buying gold, buying dollars, doing other things.
We saw what gold did too, right? So gold is, if it's any proxy, we've seen what gold's capable of. It hasn't been acting like a safe haven asset class, really. It's just, crazy momentum.
All right, so you're constructive on Bitcoin, and you think the breakout could confirm as soon as this week.
Yeah, we assume it will confirm. It doesn't mean you have to chase the move. There's a little final resistance just near current levels. So maybe some consolidation for a couple of weeks, and then that would be your trigger to add exposure. I don't think we're going to see a lot of things just run away in the way that they did this week. I think we can kind of calm down a little bit and let things confirm, let things digest and consolidate if you do want to add exposure.
You know what? I don't know. Tell me, can you imagine somebody selling Bitcoin right now?
No.
Like, what would make them want to sell it right? Like, of all the times to sell it. So, this is not science.
Sell signals. Yeah. And you can make a case from different sort of perspectives, right? You're talking almost like a money flow perspective. We're talking charts. There's the government, so there's a lot of things that are bolstering the asset class. Okay.
Hey, did you have fun on the show today?
I did, yes.
You did?
Thank you for bringing me back on.
We always have so much fun, and we always learn so much from you. I want to just ask you, before we get into favorites, for people that are unfamiliar with TAC and unfamiliar with I guess you would call it your flagship ETF, right?
The one and only.
Okay. So broad strokes, we want people to go research it, of course, but broad strokes, what is the elevator pitch? If you meet somebody for the first time and they say, should I buy your ETF? What does it do? What do you tell them?
Yeah, I think of it as the alternative to the old sort of buy and hold mentality, because dynamically it will do that for you when it's appropriate, right? So as a technician, it's hard to ride down the market in a 2008.
So it's a rules-based approach to do that for you.
Very long-term. So think of it as a slow-moving ship designed to only really change during major reversals. And it uses asset allocation to limit drawdowns. So it's not this sophisticated option strategy or something that it arguably is hard to understand and could sort of break. It's very classically moving into short-term treasuries, long-term treasuries, and gold. And that's kind of unique. And it becomes almost, the 60-40 model is getting some criticism. It actually is about a 65-35 model over history, but it's dynamic. At times it will be 100% equities like it still is now. And at other times it could be nearly 25% in gold.
Do you have any sense of who's using it, like percentage-wise, wealth management versus
I would say,
retail?
Yeah, a lot of retail and a lot of RIAs, I'd say, and we're on some of the major platforms as well. So it's been great to see the uptake there. It was number one in its category in terms of performance in Q3. So that was really awesome to see.
Congratulations.
And great risk metrics.
$200 million is a big deal for any active anything. So congratulations, and can't think of anyone more deserving than you. So
I appreciate it, Josh.
Absolutely. We always close the show with favorites, as you know. Besides Trump, is there anything that you want to shout out as what's something that you're into these days that other people should check out?
So I would say what I thought about this, because I knew you'd ask. Ancient Apocalypse.
Okay. Say more.
Have you seen this?
Oh, I thought you were calling for one. No. I'm all in. I'm ready for it.
I'm leaning in. What's this?
It's a documentary, and it goes into sort of the mysteries.
It's on Netflix?
I think it is Netflix.
Okay, I think I saw it, but I didn't
They're
watch
into
it.
the second season and highly worth it. I really think it's fascinating. I know documentaries might come off as seeming boring, but this is it really kind of challenges the common theories about when mankind, sophisticated version of mankind existed. So, and at the same time, it's a little bit of a travel log. It's really a good show.
What other conspiracies do you believe in?
Oh gosh,
Who built the pyramids, Katie? No, I'll
they go
check
into
that
that.
out.
They go to Easter Island in the episode I just watched, and the Maui, statues,
The heads.
and they go into sort of controversy around that, and it really is very compelling.
There's like a lot of Mayan stuff where they say like, how do these people build this?
It's remarkable.
Yeah.
Yeah.
Okay. No, I'm in.
Mysteries of
I
the
like
world.
stuff. I like stuff like that. Michael, do you have a favorite for us?
Last night I was watching Sam Morrill, a comedian, has a special on Amazon. It came out over the summer. It's called You've Changed, and quite funny.
That's good.
Yeah, it's
Awesome.
funny.
All right.
Write it down.
So I have two favorites of things that I haven't seen yet. Ridley Scott gave an interview to the New York Times this week. First of all, great interview. He pulls no punches. They asked him about Quentin Tarantino stopping making movies at 10. He goes, bullshit, that guy's making another movie. But he's in his 80s, and he's made some of the greatest movies of all time. Gladiator 2 is coming out, and he said it's the best movie he's ever made, or one of the best movies he's ever made. And the people that have seen it are saying Denzel Washington is going to win every Oscar.
Should we go? Let's go to the IMAX.
I bought tickets with Sprinkles.
Oh,
You're going with Shari?
Yeah, I'm going to take
Good for
Shari. She has no idea what I just did. I'm going to.
those are hard to watch, but on a big screen, it would be
It's going to be. It's going
It's
to be
gonna
awesome.
amazing.
impressive.
So I haven't seen it yet. It's my favorite. The other thing I haven't seen yet, this Saturday, they have Bill Burr coming on. So it's the first Saturday Night Live from the election. They normally have Chappelle in that spot. The last two elections, they've had him on the next Saturday night. Bill Burr is one of my favorite comics.
He's funny. Yeah.
I like that SNL is allowing these people now to do their thing. I say these people, there's kind of like an unofficial list of comics that were maybe like not politically correct.
Mm-hmm.
They're the best part of this season so far. And Bill Burr is one of the greats. So I'm looking forward to that. All right, that's it from us this week. Special thanks to the crew. You guys crushed it this week, as always. We did a lot of content. We laughed, we cried, we voted, we did all the things. Guys, thank you so much for listening to the show. I want to tell you where you can follow Katie Stockton. You're big on Twitter. It's x.com/StocktonKatie. Fairleadstrategies.com is the URL. And if you want to learn more about the TAC ETF, make sure you visit fairleadfunds.com. We're good?
Thank
Got
you
it?
so much.
All right. We're good? Everyone's good? All right. Guys, thank you so much for listening. Please subscribe. Please like. We'll see you soon.